If you're holding HBAR right now, you better be paying attention, because what's happening behind the scenes isn't just noise. It's a signal. And that signal is coming directly from the price charts, on-chain activity, and institutional positioning. Right now, HBAR is trading around $0.1975, and the market is in one of the most pivotal moments we've seen all year. This isn't about hype. It's about momentum, support, and strategy. The kind of setup where price either breaks down and shakes out weak hands, or rockets up while everyone's still asleep at the wheel. If you've been in this market long enough, you know these moments don't announce themselves. They just happen. And if you miss them, you miss the run. So let's break it all down and see what's really going on. $0.1975, a price that matters more than you think. Let's start with the number in front of us. $0.1975. To the casual observer, it might seem insignificant. A few cents. A fluctuation in the daily noise of the crypto markets. But in technical analysis, and especially in a volatile asset like HBAR, numbers like these aren't just price points. They're battlefields. On the surface, this level is just a snapshot of where Hedera is trading right now. But the real insight lies in the context. And that's where most people miss the signal. Because $0.1975 isn't just the current price of HBAR. It's a convergence point. A technical zone where past resistance, current support, and psychological pressure all collide. Let's rewind to late 2023. That was a pivotal time for HBAR. After months of sideways action and weak bullish momentum, HBAR finally started gaining traction. But as it pushed upward, it repeatedly ran into resistance at exactly this level, $0.1975. The bulls hit a wall. Multiple attempts were made to break through it. Each time, sellers stepped in and pushed price back down. But eventually, that resistance was broken. It wasn't clean. It wasn't smooth. It took volume, conviction, and news catalysts. But the breakout happened. And when resistance breaks, smart traders take note, because that level is now significant. And significant levels have a memory. Fast forward to today. HBAR isn't pushing up to this level anymore. It's coming back down to it from above. That's a big difference. Because in market structure, what was once resistance often becomes support. This is the classic resistance turned support scenario that technical analysts live for. Why does this matter? Because it shows us that $0.1975 isn't random noise. It's where buyers and sellers previously fought hard, and now it's where buyers are expected to defend the price again. Every hourly candle that closes above this zone is a silent vote of confidence. Every time price dips below it and bounces back up, that's liquidity being absorbed by strong hands. And every moment HBAR consolidates here while volume decreases, that's accumulation behavior in disguise. This price level, in many ways, is the market's way of saying, we need to make a decision. And here's the kicker. Decisions at critical levels like this one aren't decided by retail investors panicking over 1% moves. They're decided by institutional actors, long-term traders, and algorithms that are programmed to act based on these exact conditions. Let's take this a step further. There's also a psychological layer to the $0.1975 level. It's just a hair below the round number resistance of 20 cents. Traders love clean, psychological milestones. $0.10, 20 cents, 25 cents. These levels don't exist in code, but they exist in the minds of market participants. And because of that, they often act as trigger zones. Break 20 cents convincingly, and you trigger breakout algorithms. Lose 19 cents and stop-loss orders kick in. It's an emotional and mechanical battlefield. So what does this mean right now? It means that HBAR is standing at a critical technical and psychological crossroads. And crossroads aren't places to panic. They're places to pay attention. This is where trends get confirmed or reversed. Where weak hands get shaken out and strong hands step in. It's where the smart money watches the reaction, not the headline. And here's the final insight. Price levels like this don't create direction on their own. They're not predictive in isolation. What gives these levels weight is momentum. Momentum is the difference between a price that gets rejected and one that breaks through. And momentum is what we're watching now. which leads us directly into the next piece of this analysis, how momentum is building or fading in the HBAR market right now. Let's dive deeper. Momentum is slowing, and that's the point. Here's something most retail traders completely misunderstand. Momentum isn't just about how fast a price moves. It's about the intent behind that movement. It's the difference between a rocket launch and a glider adjusting for wind. When you understand momentum, you understand what the market is trying to do, even when it looks like it's doing nothing. Right now, BAR's price action is sending a very specific signal. Buyers are losing steam, but they're not giving up. That's a big distinction. Let's break this down with the technicals. The Relative Strength Index, RSI, which measures the magnitude of recent price changes to evaluate overbought or oversold conditions, has cooled off. Just a few weeks ago, BAR's RSI was flirting with overbought territory, signaling aggressive upward pressure. But now, RSI has drifted back into the middle zone. It's no longer signaling strength, but it's also not showing weakness. It's in a state of balance, hovering in that no man's land where the next move is still undecided. Then there's the MACD moving average convergence divergence. And this one paints an even clearer picture. Over the past week, the MACD histogram has been shrinking, which means the distance between the MACD line and the signal line is narrowing. In plain English, momentum is fading. The engine is still running, but it's idling. But here's the key takeaway. This is not a panic-driven reversal. The chart doesn't show sharp sell candles. There are no massive red spikes in volume, no capitulation, just a slow, methodical decline in momentum. This is what we call a controlled deceleration. It's like a pilot easing off the throttle while keeping altitude steady. The market isn't crashing. It's just catching its breath. And when markets pause like this, it's not something to fear. It's something to watch closely. Why? Because this is where opportunity forms. Not when price explodes. Not when RSI is screaming overbought, but right here in the gray zone. The majority of traders miss this phase entirely. They're either chasing green candles or panicking at red ones. They ignore these moments of pause because they lack drama. But smart money, institutions, high-frequency traders, algorithmic whales, they love this phase. Why? Because it gives them a chance to build positions without triggering alarms. Momentum is cooling, but support is holding. And that combination is rare and powerful. When support holds while momentum resets, you don't get a crash. You get accumulation. That's when the base is built for the next leg up. And that base is what we're watching right now on HBAR. This is a textbook bullish consolidation. And here's the deeper insight. Momentum doesn't need to be high to be effective. Sometimes it just needs to be shifting in the right direction. Think of it like ocean tides. You don't need a tsunami. You just need a steady current moving with intent. And right now, HBAR is in that transitional phase where the current is resetting, preparing for the next potential surge. So the question isn't, why isn't HBAR pumping? The real question is, what happens when momentum returns and support never broke? If you're watching this moment as a spectator, you're already late. But if you're analyzing this as a setup, then this slow drift isn't boring, it's strategy in motion. This is where conviction is tested. And the market is giving you the time to build yours. So don't mistake silence for weakness. This controlled momentum cooldown is part of the larger structure. It's the inhale before the next move. The pressure's building, not collapsing. This is BAR's pause, not its peak. Let's go deeper into what's fueling the structure, because beyond the charts, on-chain data and real-world catalysts are quietly aligning in the background. The hidden signals from on-chain activity. You can stare at charts all day. Moving averages, Fibonacci retracements, candle patterns, they tell you what the price is doing. But if you want to understand why the price is doing what it's doing, or why it's about to change, you need to go deeper. That means looking on-chain. Because that's where the real signals live, signals the average trader completely ignores. And right now, Hedera's on-chain data is quietly screaming bullish. Let's start with the basics, transaction volume. While the market debates whether HBAR is losing momentum, something very different is happening under the surface. Transaction throughput, TPS or transactions per second, is holding strong. And not just strong relative to itself. We're talking about enterprise-grade numbers that rival or even exceed some of the most hyped networks in the space. And here's the key detail most miss. These aren't bot transactions. This isn't spam to inflate numbers or pump a vanity metric on a dashboard. These are legitimate, verified, real-world transactions from systems operating at scale. Take Avery Dennison's Atma.io platform. This isn't some small experimental trial. This is a supply chain tracking solution for billions of physical items, running on Hedera. Not testnet, not private chain, Hedera's public mainnet. And every time a product is scanned, logged, moved, or authenticated, a transaction hits the ledger. That means real HBAR is being used to power real economic activity. Every single day. Now ask yourself this: how many other crypto projects can say that? How many are powering billion-item networks that operate in production, not white papers? And it doesn't stop there. Look at the ESG sector, one of the most critical, regulation-heavy, and economically significant frontiers in both traditional and decentralized finance. Hedera is being used right now to verify carbon credits, emissions data, and sustainability claims for major enterprises and governments. This is not a side project. These are core business operations moving onto the blockchain because of Hedera's low energy profile, fixed fee model, and high throughput architecture. In fact, this ESG use case could become a long-term driver of demand for HBAR as institutions seek auditable, tamper-proof solutions to meet carbon reporting requirements. Every single ESG solution built on Hedera is anchoring credibility to the chain, and every one of those transactions uses HBAR. And yet, none of this is fully priced in. Why? Because the market moves on hype cycles, not fundamentals. Retail attention is fleeting. It chases green candles, not deep integrations. But here's the pattern we've seen over and over again in crypto. The fundamentals always catch up to the price, eventually. And when they do, they don't trickle in, they explode. This is the asymmetry that smart investors look for. The on-chain metrics are improving, transactions up, wallets growing steadily, enterprise activity increasing, mainnet usage confirmed and consistent, HBAR utility not theoretical but measurable. Yet the price? It's consolidating. Sideways, quiet, still under 20 cents. That's your gap. That gap between real-world usage and market recognition is the silent tension that builds under the surface before big moves. It's the pressure cooker dynamic that leads to sudden repricing events, the kind that don't wait for retail consensus. And here's where things get interesting. Because when the market does finally turn its attention back to fundamentals, when the capital starts flowing in again, it's not going to be based on speculation alone. It's going to be justified, defensible, built on actual utility. And utility is sticky. It doesn't vanish with the next market rotation. That's why on-chain activity matters more than price action in the short term. Because it tells you where value is being created, not just where money is flowing temporarily. So while most are sleeping on Hedera because the price hasn't moved dramatically yet, the reality is this: the groundwork has already been laid. The pipes are already installed. The data is already flowing. And the smart money? They're not watching for green candles. They're watching on-chain. Because that's where you find the signal. Not the noise. The quiet zone before the explosion. Every major crypto rally has a quiet phase. It's the stretch of time when the market goes cold, social media falls silent, and traders move on to the next shiny object. For most people, it's boring. But for smart money, it's the signal that accumulation has begun. Right now, Hedera is in that quiet zone. Price is consolidating. Volume is down. There's no major news cycle driving hype. But under the surface, everything is lining up. On-chain activity, governance expansion, and ecosystem development. This is where breakout setups are born. In silence. Because once the breakout happens, it's already too late to position early. The move happens fast. Liquidity evaporates. And retail gets left behind. Where the price could go with and without a breakdown. There are two likely scenarios from here, and both depend on how 19 cents holds in the coming days. Scenario 1 is a breakdown. If 19 cents fails and price loses support, we're looking at a quick drop to $0.175, then potentially $0.155. Those zones represent historical demand and whale accumulation. If price reaches them, it will likely bounce hard, but only after a lot of weak hands get flushed out. Scenario 2 is a defense of 19 cents, followed by a breakout above 21 cents. If that happens, the next resistance zones are $0.235.28 and eventually $0.30 plus. Those levels line up with previous highs and fib retracements. If volume returns, those targets become very realistic. Either way, the key is not guessing. It's preparing for both outcomes and managing risk accordingly. Smart money strategy, what the whales are really doing. Whales don't trade like retail. They don't chase pumps or panic during dips. They accumulate during boredom. And right now, Hedera whale wallets are showing very clear behavior. They're not selling. On-chain data shows large wallets moving HBAR off exchanges. Supply on exchanges is decreasing. That's a classic sign of long-term accumulation. These wallets aren't looking for a quick flip. They're positioning for the next leg. They know Hedera isn't a meme coin. It's an enterprise-grade network with backing from global giants like Google, IBM, and Boeing. When you look at the HBAR Foundation's ongoing investments and grants, it's clear. Serious capital is betting on Hedera's long-term success. Enterprise adoption, still the secret weapon. Hedera's real advantage isn't just speed or low fees. It's enterprise credibility. The governing council isn't a buzzword. It's a who's who of global corporations actively shaping the protocol. That includes names like Deutsche Telekom, LG, Standard Bank, and more. These are companies with reputations on the line. They don't partner with vaporware. They partner with infrastructure. And Hedera is infrastructure. It's not trying to be a social token. It's trying to be the backbone of digital trust, whether it's identity, supply chain, tokenization, or sustainability. That's the long game, and it's still very much in play. The trader's trap, how retail gets wiped out. The crypto market runs on cycles. And those cycles repeat because human behavior repeats. Retail buys high, sells low, and misses the in-between. If you're holding HBAR, don't fall into the trap. Right now is the moment where traders get complacent. They think the rally's over. They get impatient, and they sell. But history shows us time and again, this is when the smart money is buying. The key is understanding the bigger picture. Use support zones. Watch volume. Track on-chain flows. Don't react emotionally. React strategically. Why 15 cents might be the last great dip. If HBAR breaks down, the 15 cents zone becomes critical. That's where long-term holders have historically reloaded. It's where volume spiked in the past. And it's where institutional players often start to re-enter. But here's the truth. If price gets there, it probably won't stay there long. That kind of dip is often bought up quickly. And the bounce is usually violent. So if you're planning on buying that dip, you need to be ready before it comes, not after. What you should do right now, not financial advice. So what now? What do you actually do with all this information? Here's what smart HBAR holders are doing. They're watching 19 cents like a hawk. They've set alerts. They're tracking volume. They're reading on-chain wallet flows. And most importantly, they're managing risk without emotion. They're not overexposing at a single level. They're laddering in. They're buying when the chart is boring. And they're preparing for both outcomes, breakdown and breakout. Because that's what separates smart money from emotional money. Strategy, patience, and data. Most traders lose not because they're unlucky, but because they're undisciplined. They react too late. They ignore the signals. And they chase price instead of preparing for it. But you're not most traders. You're here watching until the end, tracking real indicators and thinking like an investor, not a gambler. That's why you'll survive this market and thrive in the next one. Stay smart, stay focused, and stay ahead of the curve. Because BAR's positioning moment isn't coming. It's happening right now.